From the morning reading, small caps, financial, steel, airlines, and cruise stocks continue to climb on Monday. 6 of 10 sectors moved higher on Monday. XLF, XLRE, and XLE were the strongest sectors, while XLK was the weakest sector. Oil futures up 60 cents to close at 43.72. Breadth weakened compared to the prior session as advancers led 1,600 to 1478 on the New York Stock Exchange and led 1961 to 828 on the NASDAQ. On the S&P 500 snapshot, a flat finish, but the Treasury sell-off continues. The S&P 500 hit its 0.32% intraday high early in the session and then sold off to its negative 0.39% lunch hour low. An afternoon struggle back into a fractional green, lost traction in the final minutes, and the index finished the day flat, technically a minuscule loss of 0.01%. More dramatic today was the resumed sell-off in treasuries after the Veterans Day holiday. The yield on the 10-year note closed the session at 2.23%, up 8 basis points from Thursday's close and 86 basis points above its July closing low. Today's closing yield was the highest since January the 5th. The stock indices have formed a flagpole. After closing at a multi-month low, the S&P 500 jumped several percent in only a few days, and since then it has consolidated its gains for another 3 days, forming what looks like a flagpole on the charts. This is a textbook bullish pattern, but it has not been a good signal in the S&P or its component stocks over the years. More evidence of the split market. On Monday, more than 300 securities on the New York Stock Exchange reached a 52-week high. More than 300 also reached a 52-week low, both accounting for a remarkable 10% of all issues on the exchange. Never before have we seen anything even remotely like this, when both new highs and new lows have been made up more than 5% of all issues. The stocks have struggled every time in 50 years, as rare as it is. Gold has been pummeled. The metal lost ground for 5 out of 6 days, losing more than 5% and closing at a multi-month low. Such severe, concentrated selling pressure has tended to lead to a bounce over the next month, even since 2011, when gold was mostly mired in a bear market. It led to a bounce over the next 4 weeks every time. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk level for the upcoming day for the key U.S. financial markets. It is 6:01 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 15th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce into the morning report. And at the time of this cut, we were mixed on the 4 U.S. broad-based indices. The S&P futures were just above scratch, as were the NASDAQ futures. And the Dow futures are down just below scratch. The Russell futures were down about 0.25%. Crude oil was up big, about 2.89%. Euro was up about 0.33%. The bond was up about 0.25%, and gold was up about 0.33%. China was down just below scratch. Hong Kong up about 0.5%. Japan right around scratch, as is Germany. United Kingdom up about 0.5%. And macroeconomic reports of note for today in the United States, you have core retail sales, Empire State Manufacturing, import prices. Also, and looking forward, we have PPI, capacity utilization rate, industrial production, the crude oil inventories weekly report, and that looks to be about it. In terms of current volatility conditions, yesterday was pretty much a sideways day. Short-term volatility. Short-term VIX is at 12.51. Skew still benign. IV percentiles all very low. S&P at a 26, the Russell at a 28, NASDAQ 38, Dow at a 23. We did have some volatility yesterday in a couple markets, in that on a close-to-close basis, we had a more than one standard deviation size move on the Russell, and this continues the recent trend, with 5 out of the last 6 days being at least a one standard deviation move to the upside. On the NASDAQ, going the opposite direction and continuing with its pattern as well, in these very strange days where we have Russell up by standard deviation size moves and the NASDAQ down by standard deviation size moves. This one down a one standard deviation size move on the NASDAQ yesterday. The S&P and the Dow were less than a standard deviation move on a close-to-close basis. Go ahead and take a look at the charts, and we have the S&P futures here, and you see this sideways action. One of the morning authors mentioned a flag pattern, and indeed you have this move, which, if you include the overnight activity, went from 2028 all the way up to 2181, just 10 points away from the all-time high, and then has been consolidating in a sideways pattern since then. This is considered a bullish pattern. It's a bull flag pattern, or a pennant. And you can see how you could draw a pole like this, and then a triangle right here. And the expectation is that this is a continuation pattern and should lead to the upside. Now, the morning author mentioned that when this applies to the S&P, it hasn't been all that powerful. And indeed, in this case, I would also reinforce that in order for this to fire, it's going to fire right into the area of resistance. And we expect that with the multiple touches that this is rejected in the past, that we would expect that this area of resistance would reject the price action again until proven otherwise. Now, at some point, obviously, it will go through, but it's better to use this area as a target for an exit than it is to use an entry at this point until you get over this area. And you got to kind of, as they say, jump the creek. And when does that happen? Well, usually it's going to need something to bring in some energy and momentum into the market. Oftentimes it happens in the overnight when the professionals do it without the cash participants. And, you know, we're within a day of being able to achieve that, but we need the impetus to be able to make that happen. So failure would probably just see us continue in a complex consolidation pattern. Right now, I'm not expecting to see this break down by any measure, but that's kind of your two options. Either one of those options, the most likely probability is a slight move up or a slight move down, but not a lot of movement either way without something with energy momentum coming into the market. That's the short-term take on that. Now, more intermediate term, we very well could break through that area of resistance and continue the bullish pattern, especially when you consider what's happening in some of these other indices. Now, here with the Dow futures, of course, you see also the big move, but we don't have a flagpole here. This has been a continuation of the bullish move. Now, albeit you see how the candles, the bodies are getting smaller and we're getting more wicks. This is starting to run out of energy and exhaust, and this is more of an exhaustion pattern than it is a bull flag consolidation type pattern. Now, just because it exhausts doesn't mean it comes crashing back down to earth. It could go into its own bull flag pattern or other consolidation pattern, continuation pattern, and then continue with higher highs, higher lows. Certainly right now, there's no reason to think that the Dow is going to become anytime in the short term bearish other than through a continuation pattern. The Russell also, in a very similar pattern to the Dow, is on this really sharp move to the upside and has started to run out of energy and exhaust as well, and could be setting up for something of a short-term consolidation. We'll have to wait and see where that goes. But the primary expectation is that those two, the Dow and the Russell, would continue. Now, do they come back in a bit of a consolidation and retest the prior area of resistance, now turn support? That is actually relatively good probability. And indeed, in general, you see about 70% of these kind of horizontal breakout moves come back and retest the prior resistance. So that would be something that would be none too surprising at all. Now, the index, of course, that has not been participating in all this bullishness has been the NASDAQ. And there's been a number of theories espoused as to why. One of them being that if some of these trade deals were to become, reopen the negotiation and so forth, that the tech stocks, these big global tech stocks like Apple, would be, amongst the losers in such scenarios. If we were to, and I think this is a bit of a rhetorical flourish on the part of the media, but if we were to get into a trade war with China, for example, that Apple and its iPhone sales in China would be, one of those that would be hurt by such a trade war. And when you take a look at some of these big tech symbols and you see the sell-off since the election when everybody else has been going crazy, you can see what they're talking about with the one of the morning authors mentioned about the number of 52-week highs, and then also the remarkable numbers at the same time of 52-week lows. So we've had an enormous sector rotation going on since the election, and there's definitely been, perceived winners and losers. Now, both extremes here are likely overshoots. Some of these where you have an expectation that all is glorious, they're likely overshooting, and these that are like Apple and Amazon, the big tech stocks that have taken such a hit since the election, are probably overshooting to the downside. So you got to wait, though, I would suggest, for signs of reversal patterns. And until those reversal patterns come in, especially on something where the sympathy right now is very, very negative, well, you got to wait until you start to see, something that truly sets up as a reversal pattern, because these are volatile stocks to begin with. And then when they get volatile to the bearish side, it could get quite ugly and many percentage points before they can turn around sometimes. So you don't want to step in front of that. You rather would like to watch it closely. And then when you start to see signs of bottoming, then you start placing small positions on those, and then you grow those positions as the position becomes confirmed and truly starts to show, consolidation patterns and bottoming patterns that are starting to give you higher highs and higher lows, and then you start to add to those positions. So that's a conservative way to go at it. Now, if you're a highly aggressive trader, there certainly are probably some opportunities on the extremes on both sides of this market right now. I think about like utilities and some of these interest rate sensitive markets that are really, really moving big. Well, in this case, you might have a much larger macro cycle as the interest rate big unwind is taking place. And we take a look at Tilt, and we take a look at ZB, the futures version. This is a big unwind that would seemingly be going on, and we're likely to get a Fed action in December, just a few weeks from now. So these kinds of things might take a much, much longer path to their bottoms. Not to say that won't be bounces along the way, but the bigger picture here is to the bottom side. We take a look at the dollar. The dollar, of course, has been very strong. So when you get the dollar with that kind of strength, then you see, a lot of moves by crude oil as well. You see moves by gold, and you see moves by bonds, all, strongly down in their primary directions when you have a very, very strong dollar. So be aware of these larger macroeconomic forces that are moving these key markets at this point, and be very, very careful about stepping in front of those. You will get squashed in a hurry by these larger trade winds that are going through those markets. Okay, that's probably enough on the charts today. Let's go ahead and go to the daily report. We've had a lot of changes in this daily report in the last several sessions. Not so many between yesterday and today. Market phase 2 still, trend reversal. That's bullish. Then the 3 market timing signals. The first one from IBD, confirmed uptrend. That's bullish. GMI index, a 5 out of 6, a buy signal in place since 11:10. That's bullish. The stock charts decision point scoreboard, you see this is where we get a lot more mixed signal, though the short term has dramatically improved of recent with almost all of them in the bull camp. Now that's up against an intermediate term, and that's our primary trading frame and investing frame, where it is neutral to bearish. So just be aware that there are some very, very mixed signals here, and you see the long term has remained mixed. So overall consensus of the market timing signals is for a much improved condition for the bulls, but still not status quo, happy-go-lucky, normal, healthy bull by any means. We do not have a stack here, and we certainly don't have a long series of higher highs and higher lows when you're looking at the more intermediate term. Now, long term charts, if you're using those, we have had in recent weeks higher highs, and you've got to respect that. But it's also a position that if you're trying to get into the market, you probably need to be legging in and bringing yourself into more positive deltas a little bit at a time. Very difficult to be adding a lot of new delta exposure when you're 10 points or so away from the S&P all-time highs. In terms of position sizing opinions, both models are at 100%. Intermediate term market posture, very strong bulls being represented across all 4 indices. The S&P just under the threshold to go into severely strong bull. Dow and Russell already there. NASDAQ has actually been improving as well, and it's up over a 61 at this point. Now, this is all in the face of a strong bear sentiment line. We would expect if this bullishness continues, this slower, longer term indicator would start to roll back up and give us a bullish signal, but that has not yet happened, so you have to be taking that as a bit of a caution until it does. Overall hedge warning status remains level 1, just like yesterday. This is a caution light. It's certainly very clear that our current market conditions, while much improved from the level 3, the level 2, the level 1 plus that we've had, in recent sessions, that the risk levels have been coming down and have been subsiding. So we've been recognizing that, and yet at the same time, we do not have yet a kind of all clear, healthy bull market. That takes some time to heal that kind of damage. Now, in terms of the 3 strategy opinions, no changes from yesterday, so we won't go into a lot of detail on that. But you do have, within the opinions here, a permission for novice traders to initiate new positions. Just be considering, relatively defensive structures until we get some confirmation above these highs on the S&P. In terms of specific volatility areas, we still have a high distribution day count on the NASDAQ, on the S&P, and I forgot to change this one. This one's actually less than 120 now, so this one is no longer in warning status. We continue to see this polarity. Yesterday, the New York Stock Exchange, new highs, new lows on the 1-month indicator, over 700 to the bull side, but also over 300 to the bear side. So a lot of the components are going in opposite directions. So we've got both strong bull activity and strong bear activity that are going on in these charts on quite a few of the components of these indices of late. In terms of the intermarket risk aversion indicator, still with this one risk off and it's wavering right at the threshold. flipping back and forth, so we'll continue to watch that and see if we get a cleaner signal coming from that one. The others are still risk on. Sentiment, as neutral as you can get, currently at 53. In terms of sector specific, you can see this kind of polarity. Financials, industrials, doing very, very well, whereas kind of what we've been seeing of late, utilities still weak, consumer staples still weak, and then also of late this technology also been taking a hit, and that continued yesterday. Now, healthcare has been doing well, and it subsided a bit yesterday, but in some of those healthcare components, they picked up 8, 10, 12% in just 4 trading sessions. So that would slow down. There'll be some short-term profit taken. That's what I was saying a few moments ago. There's probably overshoots occurring on both sides of this rotation, and some of these moves have been just parabolic, and most often those parabolic moves end up with a retracement that is often as large as 50% of the prior move. So if you're in some of those, you might want to consider protecting those profits through various means at this point. In terms of the market postures, you can see quite a bit of polarity here as well, with some sectors like financials been very consistent and the first to go up, up, up across all 3 time frames, whereas we also have consumer staples and utilities have been taking quite a sector hit of late, and you see the market postures there across 3 time frames for those 2 sectors, quite the opposite direction. Percent change yesterday, again, we're starting to see better consistency across the financials, some also the industrials. Energy in general has been doing pretty well of late, whereas on the flip side, technology's really been taking a hit, and healthcare has certainly slowed down. Consumer staples and utilities all in general across all the time frames of late have been down, so something to think about there. That should be enough for today. Let's go ahead and wrap this up and get published. I'll scroll through these. Hit the pause button if you need more time to review some of the content on these slides that I'm moving through. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We'll be back here for tomorrow's market preview session. In the meantime, manage that risk, and that should bring much more consistency to your investing and trading activities. And then along with that, also seek to go out there and learn something about your craft each and every day. Good trading.